In this video, I thought it would be useful to share with you my investment plan for 2025. And in doing so, I'll go through the investment platforms that I use and why, what I'm currently invested in and why I made this choice, changes in investments and strategy plan for this year, and a general rationale for my financial decisions. My investment choices and rationale are in relation to my personal circumstances and may not suit yours. And remember that this video is a financial education video and should not be construed to be financial advice. To help you to understand the financial decisions that I make and why, I wanted to firstly provide you with some context around my circumstances. I'm married, aged 26, and have no children or other dependents. Having no kids is probably one of the reasons why I own my London home outright with no mortgage, and a major factor in me being debt-free. I technically retired in June 2023, having served 30 years in the public sector. I received a lump sum and defined benefit pension, which I have had access to since the age of 55. This means that I have a guaranteed income each month, and this provides me with a great financial foundation. Defined benefit pensions are now quite rare outside of the public sector, and the majority of people who have workplace pensions these days have defined contribution versions, where your retirement pot is not guaranteed and depends on how much you invest and how your investments perform over time. I therefore see myself as being in a good, stable financial position, and I believe that this platform enables me to be a sensible long-term investor, as there is no real pressure on me as my finances are already in order. Although I'm retired, I still choose to work, and this creates kind of a nice problem when trying to manage my personal rate of income tax. And when I show you my Vanguard account later in the video, you will understand more as to why I decided to open a pension account with them last year. Hopefully, whether you're new to investing or someone more seasoned, this video will be useful. And just before we move on, and for the record, I consider myself to be a balanced, cautious investor, and this might explain some of my investment choices as we go through them. In all four of my stocks and shares accounts, I try to be consistent and maintain a 60% equity and 40% bond allocation. Originally, this was due to my tolerance of risk as a newer investor, being more apprehensive and trying to be cautious. However, over time, I have maintained this allocation as I feel it suits me and my age, as it provides less volatility and more stability as I get closer to a time when I might want to draw on funds. I also don't feel that I need to take the risk of having a higher proportion of equities in my portfolio, as I don't need the potential gains that such an allocation might provide. Why would I want to take more of a risk than is necessary? And the risk you take in investing should be aligned to what you are trying to achieve and not for the sake of taking it. Jack Bogle, the founder and former chief executive of Vanguard Group, suggested a simple rule of thumb for bond allocation when he said that as an investor, you should hold your age in bonds. For example, if you're 40 years old, you should have 40% of bonds in your portfolio. This approach aims to reduce the risk as you get older, since bonds are generally less volatile than stocks. And lots of workplace pension funds will automatically increase your exposure to them as you get older. So it might be worth checking with your pension provider if you don't want this or don't think it suits your individual circumstances. The price of a bond can often be affected by different market conditions to those of stocks and shares. And this can make the price of bonds move in different directions to the price of equities. For instance, if investors fear a recession, they might look to pull their money out of the stock market and place it in a safe haven investment such as bonds. Accordingly, the value of bonds will then rise whilst equity prices fall. A common investing term known as negative correlation is used to describe this relationship, and having negatively correlated assets in your portfolio can help smooth out price volatility. Bogle also recommended a minimum of 20% bond allocation to all investors, regardless of their age, as this would seemingly provide some sort of stability and a little bit of income generation for your portfolio. Now, a lot of younger investors, or even older ones, might disagree with this and still choose a heavier equity allocation to try and drive faster and bigger growth in their portfolios, in line with objectives, capacity and tolerance for risk. One strong argument being that if you're not going to depend on the investments anytime soon, then why worry about price volatility in the shorter term? And if I were to follow Bogle's advice, I would now have an allocation of 56% bonds in my portfolio. But that seems a little excessive for me at this present time, even if my personal circumstances dictate that I don't need to take on a great level of risk, and that 56% allocation would probably suit. But even though my pension provides me with a guaranteed income each month, I personally still want to build a little bit more wealth to provide even better choices for when I finally decide to hang up my boots and retire for good. I need to do a full video on bonds in the near future, as they frequently get mentioned in my video but I never cover them fully. But for now, I will briefly explain the reasons why I invest in a bond fund across all my stocks and shares accounts. And this is mainly because they are boring, reliable, and generally do not set the world alight with gains or losses. They therefore add some price stability to my portfolio. And in the longer term, if the past is anything to go by, Bonds and bond funds will give better returns than cash or money market funds that will fail to keep pace with the cost of living and inflation. There are differences between owning actual bonds and the bond fund that I choose. Again, this is a bigger subject for another video, but let's just cover this quickly. Let's just say you own a government bond. With this, there is certainty. You know what interest you're getting when you buy it, and then this normally gets paid twice a year, and you will then get the full value of the bond back when it matures. Market forces can get to work, but those two figures are set in stone if you decide to hold that bond until its maturity. Bond funds, which are still less risky than equities, are a little bit more volatile than bonds. A bond fund will consist of lots of different bonds, from different borrowers and of different duration. The fund will never expire, as there will be different bonds in it maturing on different dates, and then new ones being repurchased to place the ones that are being redeemed. So there's no maturity date for you to work towards, and you don't get all your money back on a certain date like you would with an individual one. The constant churn of bonds being redeemed and new ones purchased means that the fund's price can be more exposed to market conditions such as interest rate moves or inflation. And as funds are traded on stock exchanges, market sentiment will then look at the fund's bond content and determine what the fund's value is at any given time. Wherever possible, I look to hold my investments in tax-efficient accounts such as ISAs and pensions. ISAs give me an annual £20,000 allowance to play with, and allow me to grow wealth free of any tax on interest, capital gains and dividends, with withdrawals at any time being tax-free, whilst pensions allow you to pay up to £60,000 into them per year, or your salary equivalent, whichever is the lower. Pensions also provide great tax benefits in a form of tax relief of at least 20%, while allowing your assets to grow tax-free. But whereas all withdrawals are free, and you can make withdrawals at any time with ISAs, with pensions, you will still pay tax on anything you withdraw above your personal tax allowance at your personal rate of tax, but with 25% of any withdrawal being tax-free. So let's look at my Trade-in 212 accounts, and I have 3 in all, with a stocks and shares ISA, a general invest account and a cash ISA. I used up my £20,000 ISA allowance for the 2024 to 2025 tax year by funding my Trade-in 212 cash ISA. My plan was to eventually get this £20,000 invested into my 60-40 equity bond stocks and shares ISA, maybe over 2 years or more, but not in one hit. Rather than being a lump sum investor, where the stock market will crash the day after I make that big deposit into my stocks ISA, I wanted to manage this risk by making those transfers from cash ISA to stocks ISA in smaller but regular amounts through a strategy called dollar cost averaging. This is where you make regular purchases of investments regardless of cost or market conditions. As Trade-in 212 currently offer good interest rates of 4.9% on cash ISA savings, I also take advantage of this with the cash that remains sitting in my cash ISA account, whilst I transfer £500 a month from cash ISA into stocks ISA to also take advantage of long-term investment growth. And although I have stuck to this principle, there have been occasions over the last year where markets have fallen sharply, and I've then quickly transferred an ad hoc amount from my cash ISA to my stocks ISA to buy shares when they're a little bit cheaper. I'm not saying that others should do this, as it might be construed to be trying to time the market, but I couldn't resist the temptation to try and get a bargain, and Trade-in 212 is so quick and easy to use that it made the process so simple. And I'll do this again in 2025, as there will undoubtedly be volatility at some stage, with stocks becoming cheaper at times. And this speed and ease of use is one of the reasons why I choose Trade-in 212 as one of my investment platforms, with it being seamless to transfer money between ISAs, with none of that bureaucracy that you would get if you were trying to move money between different ISA providers. But the main reason I choose to use Trade-in 212 is because of their fees. The two main costs that you're likely to encounter as an investor are the fees from the investments themselves. In funds, these are called OCFs, ongoing charge figures, or TERs, total expense ratios, and these are the fund admin fees. The other cost is the fee your broker charges you for holding your investments with them. With online investment platforms like Trade-in 212, these are called platform or custody fees. Trade-in 212 don't charge any platform fees if your choice investment is an ETF or exchange traded fund. And you can also avoid their 0.15% foreign exchange fee by ensuring that the ETFs you do choose are sterling denominated and traded on the London Stock Exchange. You will see from all my accounts that I've chosen not to invest in individual stocks and shares. I want a generally low risk portfolio, and I felt that investing in individual stocks and shares would bring higher volatility and then cause more maintenance, with the additional work of having to do constant research to keep on top of company performance. In any case, the companies that I would be interested in investing in are already featured in the funds I invest in. Every investment you will see in either my Vanguard or Trade-in 212 accounts in this video are either ETFs or mutual funds. They're all passive, low cost and low maintenance. In both my stocks ISAs and my general investor accounts, the biggest ETF investment I make is through the Vanguard FTSE Developed World UKIS ETF. This one has a ticker reference of VHVG and has a low ongoing charge figure of 0.12%. You can't avoid that OCF fee, but the aim is to try and keep it as low as possible. And I try to keep my fees as low as possible by just choosing passive funds that track an index, such as the FTSE Developed World Index, as an example of the ETF we just mentioned. And I choose passive funds rather than investing in active ones, where I would have to pay a fund manager more for the convenience of them changing the proportions of my portfolio to try and beat an index or benchmark, with me taking on the additional risks that would come with that also. This passive developed world fund provides great diversity as it invests in thousands of companies in developed countries globally, including those big US tech companies such as Apple, Nvidia and Microsoft. With that greater diversity comes more stability, as your portfolio is then less likely to be affected by any one company going out of business. So add this diversity to the diversity of investing 40% in a bond fund, and you can understand why a cautious, balanced investor like me might choose what I have chosen. This is the performance of each of my Trading 212 accounts for 2024, and this performance is mainly driven by the performance of this developed world fund, which has contributed positively. My intention is to maintain 40% bond allocation for the coming year and beyond, keeping this developed world fund as the main equity fund in my portfolio. One thing I should mention about diversity before we move any further on with this video is that as your diversity increases, you're likely to reduce the returns that you get as a trade-off for taking less risk. And only you, and your financial advisor if you have one, can work out what your portfolio allocation should be in line with your circumstances and your risk profile. For interest, the bond fund I choose to take up 40% of my Trading 2 and Invest and Stocks and Shares accounts is the Vanguard Global Aggregate Bond Fund. I decided to go with this one because it's passive with a low OCF again. It's sterling denomination and a diverse collection of good quality bonds, both government and corporate, from numerous developed countries and of varying duration. As you can see from the portfolio allocation of my Invest account, in total 55% comes from the Developed Markets Fund, 40% from that Global Bond Fund, 3% from emerging markets and 2% from UK property. I invest in the Vanguard FTSE Emerging Markets ETF to include some powerhouse countries from the developing world such as China and India, which are excluded from the developed markets, as these could be real drivers of growth in the longer term. But you can purchase emerging markets within global funds if you prefer. I find that it's cheaper to purchase them separately, and you then have more control over what exposure you want to emerging markets. In my Trading 2 and 2 Invest account, about 2% is invested in the iShares MSCI Real Estate Target UK ETF, as I wanted to invest in UK property, although I'm now having second thoughts about this. These proportions have changed slightly from what I originally said, as some of the funds have performed better than others. But I'm not in a rush to rebalance this yet, as the differences aren't massive. But I will be looking to do this later in the year to get the funds back to their original weightings. And fortunately, with Trading 2 and 2, this is really easy with the click of one button. Doing this should mean me selling my better performing funds at a higher price and buying poor performing funds cheaper. So it's a win-win situation as I see it. Rebalancing is important, generally, to ensure that your allocations keep in line with your risk profile. Remaining invested, albeit only a small amount, in the iShares MSCI Target UK Real Estate ETF is becoming a bone of contention for me. Part of me is saying, keep invested, as the UK economy is going to take off shortly and this fund will start to grow. And this fund is at a low point at the moment, so I am potentially buying undervalued stock very cheaply at present. But having featured a really good performing ETF on my channel on various occasions previously, called the iShares S&P 500 Information Technology Sector ETF, and this comes with the ticker of IITU, that's provided fantastic returns, and over 35% in the last year alone, although it comes with high volatility. I'm really tempted to switch to this one to occupy that remaining 2%. This is one of my biggest investing dilemmas for 2025. We are looking at this dilemma in relation to my Invest account, by the way, as I don't have the real estate ETF in my stocks ISA. But in every other aspect, my Trading 2 and 2 stocks ISA mirrors this one. The only difference being that the 2% allocated to my real estate ETF in this one is added to the FTSE Developed World ETF in the other. Having diverse low-risk funds for the majority of my portfolio, with smaller proportions then allocated to riskier assets, is a strategy that many investors follow and is known as the core satellite approach. And with this Trading 2 and 2 Invest account, I contribute monthly. This is not an ISA or pension, so there is no protection from tax. And I will need to get this into my stocks ISA at some stage to prevent paying tax on capital gains and dividends in the future. But at least by having this account, I am making use of my personal capital gains and dividend tax allowances for the time being. When I retired in June 2023, I also got a lump sum on top of my pension, and it is taking time to filter these into some tax efficient accounts. Part of my financial plan for this coming year, 2025 to 2026, is to transfer £20,000 into my cash ISA with Trading 212 so that I can start drip feeding it into my stocks ISA. So this will be how I use my £20,000 ISA allocation for the coming year. If pension accounts were available with Trading 212, I probably would not have the private pension I hold with Vanguard, which is a nice segue to the Vanguard investment platform and to my Vanguard accounts. The first investing account I opened was the stocks and shares ISA with Vanguard. I wanted to keep my investing low maintenance by investing in a blended fund that gives you a 60% equity, 40% bond allocation. And my very first investment was the Life Strategy 60/40 fund. But I found that I wanted more exposure to US markets and wanted to dial down the exposure I had to the UK markets a little. I then switched from this Life Strategy fund to the FTSE Developed World ETF and Global Aggregates fund to keep me in line with my Trading 212 accounts and to simplify my portfolio overall. By doing this, I reduced my OCF costs and my exposure to the UK. I've not contributed to this ISA since early 2024, as last year's allocation went to my Trading 212 accounts, and I was going to transfer my Vanguard ISA into that account also. The main reason being that Vanguard charges a small 0.15% custody fee, whilst Trading 212 is free. And as an investor, you should always try and keep your fees as low as possible. But this plan's been put on hold for the time being, as I also need to make a decision with the pension that I hold with Vanguard. I opened this pension in 2024 to help manage my personal tax rate. After retirement, I'd return to work, and a combination of my public sector pension and my wages was giving me an income in excess of £70,000. Therefore, I was going to be paying a higher rate of income tax on some of this income. About £20,000 worth would be taxed at 40%. By opening this additional personal pension, I was immediately able to get 20% of tax relief from the government, with that 20% being added to my pension account, and then got additional 20% tax relief by submitting a self-assessment tax form. In essence, by paying £20,000 into a pension, I remained as a basic rate taxpayer. And pensions are a great tax-efficient tool to help you manage this. I also have more flexibility than the average investor, which helped to inform my individual choice to open this pension. This is because of my age and that I can draw from this pension immediately, whereas if you are younger, you will have to wait until private pension age of 55, that rises to 57 in April 2028. As my personal tax allowance is already used up in my public sector pension, if I draw from this one, it will all be the subject to tax at my personal income tax rate, save for the 25% tax fee that I get on each withdrawal. From the 28th of February 2025, Vanguard are introducing a monthly £4 fee on top of their 0.15 custody charge for investors with less than £32,000 across all accounts. Moving my ISA to Trading 212 would put me under that 32k amount, and therefore make me liable for this monthly £4 fee. So my option is the status quo and to pay that admittedly low 0.15% fee, or to move all my accounts and close my Vanguard one. I do have options by using another investment platform called Invest Engine, as they offer the opportunity to open a pension account with no platform fees. And if I have another gripe with Vanguard, also making me want to move, it is that other investment platforms like Trading 212 and Invest Engine are much more user-friendly and responsive when investing. Remember that if you open a personal pension, or self-invested personal pension, SIPP as they're sometimes known, with Vanguard or another provider, you will not get the additional contributions that your employer has to make by law to a workplace pension. So always check to ensure you get the maximum you can out of your employer through your workplace scheme before going on to also or alternatively open a private one. My investments in my Vanguard pension are slightly different to the investments in the rest of my portfolio, with the equities coming from a mutual fund rather than ETF in the form of the Vanguard FTSE Developed World ex-UK Index Fund. This choice was originally influenced by the additional exposure that I was getting to the UK in that 60/40 life strategy fund I was invested in with that Vanguard. Ideally, I would now just have the FTSE Developed World ETF in this account, so that it just replicates the other accounts I have. And I will decide this year whether it's worth rectifying this by paying the transaction costs that it would take to tidy things up and to change funds. That is, if I do decide not to transfer my accounts out. You can see two different versions of the aggregate bond fund here. The only difference is that one is accumulated, meaning that any gains get paid back into the fund automatically for me, whereas the gains are paid into my cash account in the income distribution version for me to choose what to do. I personally think that accumulation versions of funds are better for long-term investors, as the reinvesting of gains is one thing less for you to worry about or to get wrong. The reason I hold a small amount of income distribution version of this fund is because of a mistaken purchase I made by choosing the wrong ticker. But this is something I might look to tidy up again this year if transaction costs justify it. Although not contributing to my Vanguard accounts for some time, they still continue to grow and have provided good returns. So with market predictions generally mixed, I'm going to maintain a 60-40 asset allocation across all featured accounts for the time being. I might close Vanguard and transfer the pension and ISA to Invest Engine. This will help me reduce fees slightly. I'm thinking of investing 2% in the information technology sector ETF rather than UK real estate ETF I currently have. And unless another platform comes in with better interest rates, my £20,000 ISA allowance for the 2025-26 year will go into my Trading 212 cash ISA. This will get another £20,000 protected from tax in an ISA and will help me to continue to easily transfer funds between ISA accounts with no bureaucracy. I also have to make room somewhere to get my Trading 212 investment account assets into a tax-efficient account, but that will probably have to be in the following year. In the meantime, I will continue to regularly invest in this one. And I need to look to remove remaining cash from my lump sum into tax-efficient accounts over the next few years. Well, I hope that going through my circumstances, thought processes, and investments has been a useful insight for you, and that you could take something away from what I've covered today to help you with your research into what you want to do in your circumstances. Remember that we're all individual, and what fits me may not necessarily suit your circumstances, and my thought process may differ from yours. When it comes to wealth building and retirement planning, if you're unsure of anything, you should always consider seeking the advice of a suitably qualified professional to help you. Thanks very much for watching.